Hi, welcome to Module 3 of our Mortgage Underwriting Training Program. This is Adenike Fasanya Oshilaja of MV Professional Solutions, Inc. And our topic today is going to be Advanced Underwriting 1, which is mortgage calculations. So we're going to be talking about why you should learn mortgage calculations. The rule is very clear, right? If you're an underwriter and you don't know your calculations, you can't find a job. Underwriting 101, mortgage calculations. You got to know the math. Now, I'm going to be using global standards because we should all know the global standards. We believe that we should train global and apply local. Train global, apply local. And therefore, because this, for now, is based on a Nigerian mortgage system, we're using the global standards plus the National Mortgage Refinance Corporation, the Nigeria Mortgage Refinance Corporation, the NMRC guidelines. So why should you know your underwriting guidelines? Because you are the gatekeeper for your company. You owe your company the duty to make sure that you minimize risk with every loan you approve for your company to give out. Now, it is your personal responsibility to access as much knowledge as you can. So, congratulations, if you're sitting here, your company considers you important enough to train you, and that is great. But you owe yourself and the entity that pays your salary a duty to also train yourself. Good. So why do we talk about mortgage underwriting standards? It is simple. If our standards are clear, we can apply them across the board. And that is what standardization means. Standardization just means taking the same rule and applying it over and over in the same fashion across the board. Your job is to make sure that the transaction and the numbers fit your guidelines. So the numbers need to match the transaction needs to fit in the guidelines you have been given for that particular kind of loan. And your goal has to be to ensure that every loan, you have the correct numbers. Your numbers must not only be correct, they must also make sense. So, let's look at the reasons for underwriting guidelines. We understand that a typical mortgage is going to be based on something, correct? So, what are your guidelines? Your guidelines will come from your investors. Your investors are the ones that are giving you the money. And because they are giving you the money, they are going to tell you what they want you to do with their money. I hope we're clear on that. So let's look at a typical mortgage. It comes with multiple calculations. What are the kind of things you're going to be calculating? You're going to be calculating your loan to value. You're going to be calculating your total monthly payment. Your total monthly payment is going to consist of your principal, interest, taxes, insurance, and assessments or other items that come as part of the transaction. And we'll go into this in a little more detail in a second. You're also going to look at income. You're going to calculate the mortgage to the income and the total debt to the income. You should also be able to calculate the closing costs. For the purposes of our loan today, we look at a flow chart. Your flow chart should document certain things. So for sure, it should document your sale price. Your sale price needs to come from the sales agreement. It will document your down payment according to the application. So what kind of loan is it? And for that particular loan, what is the down payment? The down payment, as you know, is what portion of the purchase price the buyer is putting down, is bringing to the table. The balance of that is your loan. Good. We're going to look at your income. That's going to be based on the pay stubs and the employment verification letter, which you should have gotten from the employer. We're going to look at credit. We're going to look at how you use credit and how much credit you have on the borrower's side. And we're going to look at the assets. How much does the borrower have? So don't tell me you're going to put down 30%, and then when I go to verify your assets, you only have 10%. You, as an underwriter, owe your company the duty to be able to map and navigate through all of these questions, ensure that you receive satisfactory answers to each and every one of them, and then you can say you made an informed decision. Good. So now, we're going to look at rule number 1. And why do I say rule number 1? Because even calculations have rules. Because this is math. As a matter of fact, it has been said that if your calculations are correct, your mortgage paperwork should tell a complete story. So that anybody that picks that file up, whether today or in 10 years, they don't even need to look at too much. They can look at your numbers, and your numbers will tell them the entire story about that file and about that transaction. That is the essence of good underwriting. That is expertise in your field. So, rule number 1, all calculations must be written. All calculations must be in writing. Don't do anything in your head and then skip and then go and just write the answers. We need to see step by step how you came to your conclusion. Rule number 2, you must show the basis for your calculations. You must show the basis for the factors you used. You can't just pull numbers out of the air. We need to see the rule. What was your calculation based on? What factor did you use, and where did that factor come from? It must have been from your guidelines for that particular loan. Good. Rule number 3, and I think this should be a basic one, you must balance. Am I correct? At the end of the day, it doesn't matter how great you are at calculations. If you don't balance, we don't have a deal. So you must balance. Rule number 4 goes back to what I said before. Your calculations must tell a complete story about your file, and nothing must be left out. So those are some of the most important rules. So now we're going to go straight into a calculation. And I really, really want you to listen and be attentive at this point, because I'm going to be throwing out numbers. I'm going to be doing math. I hope that you'll be able to follow me. Don't forget, you can email questions. Our web address is always at the bottom of our PowerPoint presentations. We will make our email address available to you. You can email us. I believe that is good for 30 days. So within the next 30 days, if you have any questions on this training session, please feel free to email, and you will have the guidelines for doing that. Good. So let's look at a scenario. We're going to talk about a very nice gentleman called Mr. Ojo. Mr. Ojo has come to your bank and has applied for a loan to buy a home. He wants to live in the property. So that's rule number 1. It's owner occupied. So we know we're going straight to the guidelines for owner occupancy. This is critical because it can affect your interest rate, it can affect the ratios, it can affect your down payment, it can affect everything about your loan. So rule number 1, you need to know the terms of your loan. It is my expectation that by the time you're getting to this point in your file, you have done your verifications. So you verified name, you verified identity, you verified your property, you verified income, you verified assets, you verified credit, you verified down payment. You have all your numbers together. Now it's time to do the math. Good. So Mr. Ojo is buying this beautiful house. The purchase price of the house is 10 million naira. Please start writing. Purchase price, 10 million naira. He wants to put down 3 million naira. That means he is applying to you for a loan of 7 million naira. He wants the loan for 10 years. He's saying to you, I want a loan of 7 million naira and I expect to be able to pay it off in 10 years. Good. So, Mr. Ojo has property taxes on this property because, after all, it's sitting on government land. The government has a right to charge a fee for that. And that fee is called a real estate tax. That's what the government uses to pay its own bills, correct? So the real estate tax is 240,000 naira per year. That's an important figure, 240,000 naira per year in real estate taxes. Home insurance. If something happens to the home, you need to be sure that your company is insured for your loan. So do you need the property rebuilt? Do you want your money? Whatever the case is, you need to have some form of home insurance. Your job is to make sure that it exists, that is from a reasonable company, and that it is adequate for your loan. It covers your loan adequately. Home insurance is 120,000 naira. 120,000 naira. Mr. Ojo is buying in an estate, beautiful estate, and it comes with management fees. So his annual management fees for this property are 240,000 naira per year. So 240,000 naira per year in management property expenses. So let's go to the next page. Let's look at Mr. Ojo's profile. Mr. Ojo is a great guy. He has been a civil servant for 17 years. And he makes 12 million naira per year. That's an important figure because that's income. 12 million naira per year. Mr. Ojo is a great guy. He pays all his bills on time, so you've looked at him, and he's an A+ credit risk. So he's top of the line. He has in the bank, in your bank hopefully, 6 million naira that he has set aside for this deal. So Mr. Ojo not only has 3 million naira for his down payment, he also has 3 million naira for any other thing that may come up in the process of buying this home. So Mr. Ojo is doing really great, correct? Now, Mr. Ojo has a car loan, and he pays 60,000 naira per year, which is 5,000 naira per month. He pays 5,000 naira per month on the car loan. He also took out a personal loan last Christmas, and he pays 60,000 naira per year on the personal loan too. So he has a car loan for 60,000, personal loan for 60,000, always makes his payments on time, great credit risk, he's an A+ borrower. So what are the factors that affect your collateral? The sales price, 10 million naira. Taxes, real estate taxes, 240,000 naira. Home insurance, 120,000 naira. Management fees, 240,000 naira. So you put all of that into your mortgage insurance risk calculator, and you get back what we call your mortgage insurance factor. The factor is always going to be a decimal point, and is going to tell you the decimal point factor number that you are going to use to calculate the monthly naira payment for his mortgage insurance. In his case, because he's an A borrower, his factor is 0.000 I'll say that again. His mortgage insurance factor is 0.0060. So, those are the numbers that affect our collateral. The numbers that affect our borrower, income, 12 million naira per year. Debt, 120,000 naira per year. Assets, 6 million naira per year. Down payment, 3 million naira per year. So we have all our numbers. Let's go look at who is going to guarantee this loan. Who are we trying to sell this loan to? Because your bank doesn't want to keep this loan forever. Your bank wants to make this loan, make the spread, sell it to somebody else, and then make the next loan. That's why you're there. It is to ensure that they do get that money back by selling that loan, and they can give it to the next person. So, let's assume our investor is NMRC. And the debt ratio for this borrower is 33%. These are all assumptions now. It is your duty to pick up the NMRC guidelines and read them and check them off against your loan. So don't use my numbers and say they are set in stone. This is a scenario. So we're doing 33% debt ratio. But I'm going to show you a global standard on that. So again, we assume that you have verified identity, employment, source of funds, income, all of that good stuff, property and all of that, and you have done all due diligence, correct? Let's do the math. The first thing we're going to calculate is our loan parameters. What are our loan parameters? How do you get to your loan amount? Sales price minus down payment equals loan amount. Sales price, SP, minus down payment, DP, equals loan amount, LA. Sales price of 10 million naira minus down payment of 3 million naira equals loan amount of 7 million naira. Calculation 2, loan to value. Loan to value is made up of loan amount divided by sales price times 100%. Are we good on that? Loan amount, LA, divided by sales price, SP, times 100. And we express that as a percentage. 7 million loan amount divided by sales price, 10 million, times 100, expressed as a percentage, is going to be 70%. Our loan to value on this loan is 70%. Good. I hope you are following me, and I hope you are getting this very clear. This is really important. Our interest rate is 22%. Our term is 120 months. Clear? 7 million naira at 22%, amortized, broken down over 120 months is going to give you a principal and interest payment only of 144,687.81 naira per month. Remember, we did this over 120 months, so this is now coming down. Instead of the per annum we were doing before, at the end of the day, our loan is going to be expressed in a monthly figure system. I hope we're clear on that. So, again, our loan amount of 7 million naira at 22% amortized over 10 years, which is 120 months, is going to give you a monthly payment, principal and interest, of 144,687.81 naira. Congratulations, you did your first hard math. Our taxes, we're going to take it from the yearly and bring it down to the month. So 240,000 naira over 12 months is going to be 20,000 naira per month, correct? Home insurance is 120,000 naira per year divided by 12 months, which is going to give us 10,000 naira per year, per month. So 10,000 naira per month. Management fees for the estate, 240,000 naira divided by 12 months is going to give us 20,000 naira per month. So let's go over that. Our monthly figures now are principal and interest, 144,687.81, 144,687 naira and 81 kobo. Taxes, 20,000 naira per month. Home insurance, 10,000 naira per month. Management fees, 20,000 naira per month. So now let's calculate mortgage insurance. I don't know if you've done this before, but the essence of expertise in underwriting is that if you are underwriting a file and your systems crash or the lights go off, there's no electricity for a week, should you be handicapped? Should you be paralyzed and unable to work? Definitely not. You should be able to do the math, whether you're using a computer software system or the most basic calculator. That is expertise. The capacity to get the job done correctly no matter what obstacles are in your way. So, I want you to be able to calculate these figures on your calculator. So, how do you calculate mortgage insurance? Let us first understand the purpose of mortgage insurance. Mortgage insurance is supposed to minimize your company's risk, correct? So it is insurance that is force-placed on the loan. It is force-placed. The borrower has no say in the matter. He is going to pay the premium, but it has nothing to do with him. It protects your company in case of default. With mortgage insurance, the better the risk, the lower the mortgage insurance payment, as with any other insurance, right? The better the risk, the lower the premium. The better your credit, the better your risk, the lower your mortgage insurance premium. So when you have two borrowers, all have the same profile except Mr. Ojo pays all his bills on time, Mr. Sunday does not pay his bills on time. Automatically, Mr. Ojo's mortgage insurance premium should be lower than Mr. Sunday's mortgage insurance premium. and therefore his monthly payments should be lower. Mortgage insurance protects against risk. The lower your factor, the lower your payment. So remember, for Mr. Ojo, we had a 0.0060 factor because he's such a great borrower. Mr. Sunday's factor might be 0.600, which means he is 10 times worse as a risk than Mr. Ojo is. You understand that? So, or is he 100 times? We'll do that math. Or you'll do that math. So, let us find out the formula for calculating mortgage insurance. When you put that factor on the paper, what do you do next? Loan amount times mortgage factor divided by 12 is your premium. Loan amount times mortgage factor divided by 12. That is your mortgage insurance premium monthly payment. Loan amount 7 million naira, correct? Times mortgage insurance factor 0.0060. You get that number, divide by 12. My calculations show 7 million naira times 0.0060 is 42,000 naira. That is per year. Divide by 12, 3,500 naira. 3,500 naira per month. That's what you add into the monthly payment for mortgage insurance. So where does that leave us? Let's kind of go back over those numbers, okay? Our complete monthly payment. Remember, principal, interest, taxes, insurance, and all others. Principal and interest, 144,687.81. Real estate taxes, 20,000 naira. Home insurance, 10,000 naira. Management fees, 20,000 naira. Monthly mortgage insurance, 3,500 naira. Our total monthly payment for Mr. Ojo's loan is going to be 194,687.81. Are we clear? 194,687 naira and 81 kobo. Congratulations. You have found the most important mortgage calculation in this training session. What is your total monthly payment? It determines everything about your loan. If you cannot get to this point, you have a bad loan. Good. So now that we have finished with that, we can now take that figure and we can go and calculate the debt ratios. Remember, the NMRC guideline for this loan is that this monthly payment cannot be more than 33% of Mr. Ojo's monthly income. Mr. Ojo makes 12 million naira per year, i.e., Mr. Ojo makes 1 million naira per month, i.e., the maximum that Mr. Ojo will be allowed to spend on a mortgage is 33% of 1 million naira, which is 330,000 naira. That was a simple calculation. Loan amount times debt to income maximum ratio allowed is going to give you total monthly payment allowed for the loan repayment. However, the NMRC gives you one debt ratio. One. It says the loan cannot be more than 33%. Let us look at a global guideline. We're going to go again to Fannie Mae. With the Fannie Mae standard, your loan cannot be more than 33% of your income, but your total debt, which is your loan plus any other loans you have, can go up to 41% or 43% or 45%, as the case may be, because the guidelines change continuously. So it can be up to 45% of your monthly income. So you see, Fannie Mae has two ratios. We use two ratios. We call them the loan to your income, your mortgage payment, total mortgage payment to income. That gives us our primary debt ratio, which we call the front ratio. The front ratio. Then we do a second calculation. We take that mortgage payment, that total mortgage payment, and we add in all other bills that you have, and that we use to determine your total debt ratio. So we have your loan to income ratio of up to 33%, and then we have your total debt to income ratio of up to 45%. So you're going to have two ratios, and it's going to be your front ratio and your back ratio. So we will say 33/41 or 33/45, as the case may be. According to NMRC, you use one ratio, and NMRC uses that second calculation, which is what we call the back ratio, your total debt to your income. They don't bother with the mortgage payment to income. So we want to do 33%. What does this mean? For Mr. Ojo here, his principal and interest, his real estate taxes, his home insurance, his mortgage insurance, his management fees, his car loan, and his personal loan will all be added up. And that will be what we use as our calculation for the debt ratio. Good. So our total mortgage payment, PITIA, again, was 194,687 naira and 51 cents. Let's throw out all the naira and kobo, correct? So we have 194,687.51 plus car loan, 5,000 naira. Correct? Personal loan, 5,000 naira. Therefore, Mr. Ojo has a total monthly bill payment of 204,687.81. That is the number we use for our debt calculation. Mr. Ojo's total debt versus his income is going to be total debt divided by income. Total monthly payment divided by total monthly income. 204,687.81 divided by 1 million. Our debt ratio is 20.47%. We can go up to 33%. Congratulations, Mr. Ojo. Your loan is approved. In fact, we are delighted to have you as a customer. So, you write all your findings and you sign off on your findings. I always advise that you initial every page. Sign off on your findings, put your file together, get all your calculations and your figures and your numbers and everything, put them all together and turn them in because you are done. Now, if you were in America, you have to do 2 calculations, correct? So, the front ratio, that is before the other debt, would be 19.47%, 19.47%. And your back ratio, which is your total debt to your income, will be 20.47%. That is the art of mortgage calculation. Let's throw a little wrench in these figures. Let's assume everything else stays the same. Everything else is the same, but Mr. Ojo's property is being sold not for 10 million naira, but for 50 million naira. Let's assume his purchase price is 50 million naira. Go through the same math. Mr. Ojo's total monthly payment for principal, interest, taxes, and insurance and all other debt concerning the property increases to 434,063 naira and 44 kobo. Again, that is 434,063 naira and 44 kobo. 434,063.44. Our ratio jumps to 49.41%. 49.41%. And all of a sudden, Mr. Ojo no longer fits within our investor guidelines. And what do we have to do? We have to deny the loan. And we have to send Mr. Ojo a very nice letter saying, unfortunately, this particular property didn't work for you. But we would still love your business. Please find something a little less costly and do return to us. We have all your paperwork ready. We have everything in place. It won't take us any time because we already know you. We already have a very solid underwriting system in place for you. We have an underwriting process that we have already completed for you. So if you are great, just bring another property, maybe something, a little lower. And then you sit with your loan officer and you say to your loan officer, excuse me, why would you tell Mr. Ojo it would be okay for him to buy a 50 million naira property, knowing full well that his maximum debt ratio is 33%. The loan officer needs to redo their math and give Mr. Ojo another pre-approval letter saying you can only buy up to 25 million, 20 million, whatever the math comes to, and have Mr. Ojo try again. This is why it is critical to have your client pre-qualified before they go look for a home. Because consider that a home buying experience is always going to be one of the most emotional things that a buyer is going to go through. Because after all, the mortgage is probably going to be the highest loan amount any individual takes out in their lifetime. So when Mr. Ojo thought he could buy a 50 million naira property, he went straight to VI, to the Lekki subdivision somewhere, and he found this beautiful home. Or he went to Ikeja GRA or Magodo and he found a beautiful home. And then he goes through all of that and you have to tell him he can't get that home. He's now limited to 20 million naira. All of a sudden, if he wants to stay in that location, he has to buy down. So instead of buying a 5-bedroom ensuite maisonette, he may have to buy a 3-bedroom flat. Or he will have to give up location. So he can still get the 5-bedroom maisonette, but he may now have to go to Mowe for it. That is not fair to your borrower. That is very unfair to your borrower. And one of the biggest tasks for a mortgage company that is worth its salt is to give your borrowers the right guidance so that they get it right every time. That's what reputations are built upon. That's what companies are known for. That's what determines who survives in the market and who does not. And certainly, that's what determines an expert underwriter versus one that is not. So, understand that your responsibilities go beyond the math. Yes, it's great that you've done the math. It's great that you put the figures together. But you are a guide. You are a guide. You guide the loan officer. The loan officer is not an expert in underwriting. If they were, they would be the underwriter and you would not have a job. So if you are going to close loans and make income for your company, the loan officer, relationship manager, whoever you call them, whatever your company names them as, must be working hand in hand with you. And every time your guidelines change, you have a responsibility to notify the loan officer and actually kind of take them through it so that they get it too. If you don't have that responsibility, your office has that responsibility. If your office is missing on that responsibility, if they haven't done it, go ahead and do it. Why not? It makes you look good too. And then your name is known in the market for doing consistently good work. So let's wrap up. Because this was a tough one. We went through actual figures, and sometimes with numbers, it can get a little dicey. The calculations we just did are easily the most important ones that you are going to do with every loan. You have to be extremely comfortable with these particular calculations. You have to wake up and know it. Sleep knowing it. You should be able to walk into your office, pick up a file, and get this done and out of the way. If this particular calculation is giving you problems, your company has a problem. You need training. because it only gets tougher. Your company depends on you to get this right every single time. Every single time. So remember, you verify all your information, make sure that they're all correct. You pick up your guidelines, you check the boxes and make sure that the loan matches all your guidelines. Then you start putting your numbers together. Make sure you have all your numbers in a row. Then you do your math and make sure that you follow every step. Make sure that you balance. Then you take your figures and go back to your guidelines and you match them again. And if they match, you have an approvable loan. If they don't match, you must deny. Thank you. That brings us to the end of this particular session. Remember that this is one of a series of sessions. If you want to be adequately prepared for what you do, you need to go through each and every one of the sessions. It is our hope that when your company purchased this underwriting program, they purchased the whole thing. Please go through them in sequence because they do follow one another. Having said that, don't forget that we have multiple training platforms at MV Professional Solutions, Inc. You can go to our website and you'll see some information on us. We will train through this platform, which is a webinar-style training program. You are watching this, but you have no access to me directly, except by email. We will train by live streaming, which means I'll be training you, but you'll be seeing me and you will be able to interact with me real time. So this will be a true training session with me in the room, except I'm in a room across the ocean and you are in the room in your office. And finally, and which we think, of course, is always the best solution, we can come to you or you can come to us. And then we are actually in the same room and we're training you face to face live, and you are asking your questions right there to our faces, and we are answering those questions right there back at you. So you have multiple training options with us. Our goal is to ensure that our mortgage training sessions prepare you to be the best that you can be in your industry and to uplift this industry, this emerging market, to uplift it, to make it a globally standardized, acceptable market internationally, so that when you go to sell your MBSs, your mortgage-backed securities, no questions asked, you can get everything on the table and get your loans purchased. Congratulations, thank you for making it this far, and we will see you in the next session, mortgage underwriting, appraisal, valuation, and title search analysis. Bye-bye.